thank you to the organizers and to Barcelona Graduate School for inviting me to be here. Thank you to Jaume for putting the question. I am disappointed that Jordi did not answer it fully, when the crisis will end. Roger was more precise, March 2015, so thank you, Roger. In fact, I also will give you a very definite answer to the question, with two pieces of evidence, in fact. The first piece of evidence has to do with, in fact, with what Roger has been speaking about, and is the stock market recovery. So if we look at the Dow Jones and we look at the peaks in 1929 and 2007, so we have recovered, while in the 1930s we didn't. So if we look at at least the US stock market, the crisis is over. Also, there is a hint in the declarations of the Spanish ministers that they say that the crisis is over. So this maybe they know something, although they've been saying this from the beginning. So, but still, okay. So that's another. Okay. So what I would like to do, and so I'm afraid maybe my remarks will be slightly more boring because I will talk more about financial regulation and problems that banks have had. But before doing that, I would like to maybe to summarize a little bit where we are in the crisis, and I will do it with this index, which sometimes is called the fear index. That's an index of implied volatility of options on the SP 500 traded in Chicago. And if this is high, it means that there is more perceived risk. And as you see, the peaks of this index coincide with shocks, basically, either wars or big financial crisis. We had also the World Trade Center, the 2001 attack also. But basically, we see that the big one was Lehman Brothers. This was the financial meltdown. So the possibility of the financial meltdown in the world. So this was taken very seriously by the markets. This was a systemic crisis. Then we went on to also what Jordi has mentioned, to the sovereign debt crisis and to the perceived risk of the euro breaking up. So here we have the different peaks typically associated with things that happen in Greece, for example. And so we have several. And then finally, well, now we see that it looks more tamed. And we'll see, I will go back to this at the end, whether it's really more tamed or whether we can see more spikes on this risk index. So I would like to tell you a little bit about the financial crisis. So just to remind you that we've had many crises. So this, in fact, is taken from Reinhardt and Rogoff, proportion of countries with banking crisis basically in the last century up to the present crisis. We had many, the peaks, also in the Great Depression. We have in the middle, you see in the 50s and 60s, a period with basically no crisis. This was a period of financial repression where basically banks were told what to do. Okay, we were not allowed to do anything, basically. So they were told what to do, what to charge for loans, deposits, etc. So this was very difficult to take risk. And now we are in the and this continues. This was I think in 2000 whatever 9 or so, but this continues. So the question obviously is whether we'll be ever learn to deal with financial crisis. The context of the crisis, I think, well, I don't know if maybe it's known already, but definitely something that played a role to understand what needs to be done to reform financial regulation is that there were faulty risk assessments. So risk assessments even based on wrong statistical models that ignore tail risk. there was been inadequate regulation, in which I will talk more about that. All this led to excessive credit and leverage, the housing bubble, subprime mortgages, and all these complex assets built on top of the subprime mortgages, which no one understood very well, but at the end they looked very ugly. Interest rates went up. In the US, the US housing bubble was punctured, and there we go. So the risk of this type of thing happening is very real, and also as Jordi kind of pointed it out. Is the current crisis similar or not to past crises? Or I don't know, which was this kind of very cyclical thing. So this is the picture of the bank panic in October 1907. This was an important bank panic in the US, that in fact is Wall Street. I think one can see even the statue of George Washington if you look carefully. So now you have to compare this picture with another one 100 years later. That's bank panic in October 2007, so this was October 1907. That's Northern Rock, except for the quality of the picture, which is worse in the recent one, so, but that's for other reasons, and it's in color, looks pretty similar. So this really means that the financial system has an inherent fragility. And also we can think, well, who rescued, who solved these problems and with the banking panics and the fragility of the system, Who are the saviors? Well, in 1907 was J.P. Morgan, so this is stern look. He provided the money. Also, I think Rockefeller pledged half his wealth to quell this crisis, which, by the way, this crisis started also because of something called a shadow banking system. That's 1907, not 2007, which developed too much. Okay, so maybe this also sounds familiar to what has happened later. Now, who are the saviors now? You know who's coming now, right? So it was not a private solution. There was no Fed in 1907, so with no mandate to preserve financial stability. So now they look nice. Here, our saviors. Okay, so the summary diagnosis is that we've had a financial system with excessive maturity transformation, with institutions with very high leverage, low transparency, low capital levels, this shadow banking system with very opaque products and little regulation. In fact, this was like in 1907, by the way. On top, we had generalized incentive problems. So from the moment that you were going to get a mortgage to the moment that this mortgage conveniently transformed with derivative products, Square and Cube, etc., were sold to the usual Landesbank. So, I mean, the whole incentive chain was full of problems and misalignments with the social incentives in particular. And also, we had this incorrect use of risk assessment models. So the outcome was huge unperceived systemic risk and what we call adverse selection problems. So this type of situations in which if you want to trade with me, I do not want to trade with you because I don't trust you. And this frees up interbank markets. And there was, in fact, from our perspective, from the perspective of the periphery of Europe, a sudden stop of capital flows. So we were, in fact, like an emerging country in this sense, and we suffered the subsequent sovereign debt crisis, and I mean, later on maybe we may say something more on that. Okay, so regulation failed. There was excessive risk-taking in banks and financial institutions and the financial system. There was not much market discipline, be it because institutions were expected to be bailed out, or be it because of deposit insurance, be it because regulators, when there is a problem, tend to look away, tend to look at another, not where the problem is, because this is by definition problematic, so they tend to look at another place where the problem is not there, and then do something maybe, and then that's not even a good idea. And then regulation had this mismatch with the new realities. because of this lack of the systemic effects and this enlarged opacity in the financial system. There was a lot of regulatory arbitrage, so the institutions could work in the shadow system with no requirements. So why work then in the regular system with lots of requirements? Why? It was much more costly to work in the regular system. This was compounded by insufficient capital and liquidity requirements, and even by some procyclicality of those requirements. Also, there was excessive confidence on the corporate governance controls and self-regulation. So the famous phrase by Alan Greenspan saying that he had not assessed correctly, the self-regulating capacity of the private sector. Greenspan thought it was infinite, obviously, and also regulatory capture by some of the interests of the sector. Okay, so here, just quite quickly, so to see where we were going. So, for example, if you look at liquidity requirements in US banks, you see that starting, let's say, in 1960, consistently went down and only recovered because of the crisis. Okay. Capital requirements, capital ratios for UK and US banks, if you start in the 19th century, they have been going down dramatically. And even, so this is not taking into account that assets are risk-weighted. If you think they're risk-weighted, so then maybe more. If you look at the balance sheet of institutions, so let's look at the balance sheet of Lehman Brothers in 2007. Good year to look at the balance sheet of Lehman Brothers in 2007. This was an extremely safe institution. Okay, so I mean, so here there were people in Spain selling bonds, and insured by Lehman Brothers. So look at the following. Look at the liability side. So forget about the asset side. The liability side, if you look at what are stable funds, so funds that cannot fly very quickly, you have equity, 3%. Long-term debt, 18%. That's 21%. The rest can fly immediately, and basically that's what happened. And this was not only with Lehman Brothers, but Bear Stearns and many of those investment banks that basically disappeared, and they transformed themselves into commercial banks to be under the umbrella, the protective umbrella of the Fed. So here, then I would like to make a connection also with the 1930s and the Great Depression. In the 1930s, I think there's a consensus among economists, and from the critique of Friedman and Schwartz to the policy that the Fed followed, that there was a lack of attention to liquidity. So basically, that the Fed did not provide adequate liquidity to counteract the Great Depression. Okay? And now in the Great Recession, so the one that does not exist in a sense, but the one that we are, maybe, I mean, there is a hint that maybe there is a lack of attention to solvency, perhaps, because, I don't know, at least in some instances, European banking problems were thought to be liquidity problems, well, definitely in Spain, so until they turned out not to be liquidity problems. In Europe, same thing, Draghi's put, which by this I just mean that his insurance of this is special operation to insure short-term bonds up to 3 years. This is based on the idea that euro fragility is kind of self-fulfilling. So if you say that this will not happen, it will not happen. Okay, but as also Jordi has reminded us, we'll see whether this is true, because there are other issues, not only components which are self-fulfilling and liquidity-driven. And then at the end of the day, so we can pose the question, so why banks are so reluctant to lend? They are inundated with liquidity. So why they do not lend? Or why they are so reluctant to lend? Okay, so let me just quickly go through some principles for financial reform, given the experience of this crisis and previous crisis, and so this responds to the lessons. So I have responded already when the crisis will end. I said it has ended already. So and the principle for what lessons? So these are the principles. So that's the second part of the first part of the question. So the first part is the following. I would say that the first thing is that, and this I will see things a little bit differently than Roger, so we can start the discussion. Central banks basically have two, or should have, I don't know if have or should have, two objectives. One is economic stability, what typically understood as price stability, and the other is financial stability. And then for those two objectives, you need two instruments. So one instrument, well, is the interest rate that would be for economic stability or price stability. And then you need, for financial stability, so these central banks have failed on this account miserably, and they need to take very seriously macroprudential measures. Okay, so the rules so that there is not overborrowing typically during credit expansion. So these are basically prudential rules. I will not be specific on that, but I think it's definitely a must to control bubbles. So bubbles are not controlled with Greenspan basically, when in trouble, lowering the interest rate. In fact, to prop up the stock market, so it follows Rogers' theory, but I am not sure it worked. So we can argue about that. And basically, it should take into account capital and liquidity needs also through the economic cycle. Second, we need a holistic approach to financial regulation. So when the regulator sets capital requirements and liquidity requirements and transparency requirements and the degree of liberalization of the markets, has to think about all this together. So regulators tend to think, well, we have to improve capital requirements. So then when we have done this, now let's look at liquidity requirements, and now let's look at transparency. Well, these things have to be thought together because they interact. Okay, and we've seen that the interactions are important. We need also uniform regulatory standards for all institutions that work like banks, independently whether they are called banks or not. Okay, independently whether they are called banks or not, and also internationally. Okay, so to prevent regulatory arbitrage. We need also to implement resolution mechanisms for institutions, for financial institutions. So that everyone understands, so that banks can fail, okay, so, that maintain market discipline and stability at the same time. So the European Commission and Central Bank and in Europe, also in other countries, working on these bail-in rules. So who should take the hit when a financial institution fails? No, the shareholders, the bondholders, no, even maybe depositors. But then this has to be thought through carefully. And also bailout rules, and who puts the money. Maybe also it can be the same sector, but with risk-based assessments of the different positions of the institutions. They should not be treated uniformly, and with a fiscal backstop. So in fact, yesterday, I think the European or the Eurogroup decided that the European Stability Mechanism can use up to 60,000 million euro to directly recapitalize banks. Okay, so that's the fiscal backstop. Small, that's small, that's not very much, but it's a beginning. It's a beginning of this banking union that is needed to stabilize the euro area. On bank structure, there has been also some progress, and it should be done. So there was the Vickers report in the UK, the Liikanen report in Europe, the Dodd-Frank Act in the US, and several reports which pointed out that activities of particularly the regulated parts of banks should be controlled. Okay, so there should be some ring fencing, for example, of the activities of deposit and loans to the more risky activities. These should be better capitalized to protect the taxpayer and the financial system. And systemic institutions should be confronted a little bit with their external cost of failure. And finally, last but not least, and with this I think I almost will end, we should develop mechanisms to make sure that supervisors and regulators intervene when they have to intervene to avoid the Japanese problem, which is not only Japanese, it happens in other countries, of basically having forbearance, with all the problems and with all the banks that then developed into zombie institutions, which cannot lend because they have a balance sheet problem, and really they are not resolved or neither well capitalized. No? Thinking that a recovery that does not quite arrive will resolve the situation. So basically it's like prompt corrective action, right? Trying to prevent this regulatory forbearance. My assessment of what has been done up to now in financial regulation is that basically we're moving in the right direction, maybe unevenly, and still with some ideas which are not very clear that they will deliver. So for example, some ideas to tax financial institutions, they are not thought under the idea that we have to correct externalities caused by those financial institutions, but just to raise money. Okay, so then the banks have cost us a lot, okay, now let's raise money, one way or the other. There are other sectors, and now I see people in the first row, so other sectors like in the energy sector that maybe also the governments have similar ideas, but definitely in the banking sector also is the same. So I will leave it here. I have some remarks and comments about the Euro, Europe, and Spain, but I think it's better if we do it. I just will show you the picture that we can comment later on the future of the Euro and how long Draghi's magic will work. Okay.